So I hope you're having a good conference, and thank you for staying on. I can promise you that this will be a real treat, this session. So my name is Soumitra, and I have the distinct honor and privilege of being requested to moderate the session. The session's title is, How Will the U.S. Economy Impact Emerging Markets in the Coming Period? And we have four very distinguished colleagues, panel members, to help us debate and sort of flesh out the topic. On my immediate right is Rakesh Mohan, who is a distinguished fellow at Brookings, India. To his right is Kenneth, who is a managing director at Warburg, Pincus in USA. To his right is Nicholas Stern, who is the chair of economics and government at LSE in the UK. And to his right, last but not least, is Nelson Cunningham, president and co-founder of McLarty Associates in the USA. Now, I think, when one looks at the world today, it's very hard to talk about any kind of economic development without talking about America. And that's really partially because the US is the largest economy in the world, but also because at different moments in the economic development of the world, especially in recent decades, the US has often been the engine, the locomotive for the world train. And now, of course, we are in a very interesting situation where the US seems to be going strong, recovered quite well from some of the crisis from 7-8 years ago. As you probably saw, the job creation is still strong in the latest month released in March. I'm the dean of a business school in the USA, and I sense the confidence in both the companies who come recruiting students and the students themselves as they look at their future career prospects in the country. And all of this, of course, in the backdrop of increased uncertainty in the world around us, what is happening in China, what is happening in Latin America. India is a bright spot to some degree, but a lot of the emerging markets are, some people would say, at historic bottom in many respects. And then there's an increasing question around the US election, which was referred to in the lunch session, that one would have probably not imagined some years ago that the US internal politics would throw in an additional element of uncertainty into what the global economy can look like. My wife right now is, in fact, in Puerto Rico giving a talk out there in a similar conference. When I spoke to her this morning, she told me that people in Puerto Rico are actually very worried what happens if Trump becomes the president, because they're worried that they might take the US passport away from them and somehow make other kinds of actions which were previously unheard of or unthought of. So a lot of interesting developments on the horizon, and to flesh them out, we have four great speakers. So without further delay, let me pass the microphone to Ken Juster to help begin the debate and discussion around this very important theme. Ken.
Okay, well, thank you very much, and it's a pleasure to be here this afternoon. I'd like to briefly discuss the current state of the U.S. economy, and in particular the role of the Federal Reserve Bank of the United States in stimulating the economic recovery that we've had and its impact on emerging markets, and then I'll conclude with a few thoughts on where things might go from here. As has been mentioned, the U.S. economy is generally in good shape and is doing better than other advanced economies. Growth is improving slowly but steadily. It's projected to be about 2.2 to 2.4% this year. Consumer spending has been resilient, and with lower gas prices, that should be a boost to further consumer spending. The unemployment rate has been at or slightly below 5%, and economists would say that that's at the level of full employment. Now, while there has been a slight increase in the labor participation rate in the economy, the fact is that it's still well below what it has been in the past, in part because a number of people have dropped out of the labor force and others have taken part-time positions, so that even though the unemployment rate is down to 5%, or it was previously 4.9%, there is still anxiety among the American workers. But overall, one would clearly have to say that the U.S. economy is in much better shape than that of other advanced economies and is at its strongest footing since the financial crisis of 2008. One might expect, therefore, that with a modest amount of growth in the United States, that would have a clearly positive impact on emerging markets, with U.S. consumers having more money to purchase exports from abroad and U.S. investors having greater resources to invest in emerging economies. And the situation is just not quite that simple, in part because of the role that the Federal Reserve has played in stimulating the U.S. economy. And so let me just briefly touch on that. As you may well know, the Federal Reserve Bank has been using an unconventional monetary policy known as quantitative easing, in which they were purchasing government and other securities on the market in order to lower interest rates and increase the money supply. This is designed to stimulate borrowing and spending in the United States. But at the same time, as expected, the lower cost of capital also led portfolio managers to pursue higher rates of growth in emerging markets in higher risk assets. In addition, the extremely low interest rates led borrowers in emerging markets at both the government and the corporate level to incur significant debt in dollars overseas. So you saw from 2009 to 2014 an enormous inflow of capital, I think maybe $5 trillion at that order of magnitude, into emerging markets, which really helped boost the growth rate in those markets to well above what you have in the advanced economies. But it also has created some risks both for the U.S. economy and for emerging markets. First, in the United States, you have total debt levels now at all-time highs for the government and for the Fed, much higher than obviously before the financial crisis, while interest rates still remain extremely low. The risk here is that if there is another downturn, which is not totally out of the question, the Fed, as well as other central banks, have already applied almost every conventional and unconventional policy tool at their disposal, and so there's little resiliency left in the system for policy prescriptions if we have a downturn. In terms of emerging markets, with global capital markets interconnected, these markets have become extremely vulnerable to shifts in market dynamics. And we saw this in May of 2013 when the Fed announced that it would start to taper back on quantitative easing. Even though it hadn't actually begun the process, just the announcement led to capital outflows from the emerging markets and to a precipitous drop in global securities and equities. And now the question is, as the Fed gradually begins to raise interest rates at the same time that you see the European and the Japanese central banks trying to loosen monetary policy, we're really entering uncharted territory. There were, for the first time in 2015, significant capital outflows from global emerging markets. It's the first time since 1988. And the question now is whether the markets have fully adjusted to what will be the gradual raising of interest rates, or whether when this process continues to take place, at least in the short term, there will be continued outflows from emerging markets. Another ramification of the Fed's gradual raising of interest rates is that governments and borrowers in emerging markets may struggle to repay some of their liabilities. And certainly you'll see some companies in which they'll have debts that will become unsustainable, and it will probably lead at least some companies to go out of business, which obviously is not a good development. Now, I've been making some generalization about emerging markets, and clearly there are differences when you focus in on particular countries, and some will be able to weather the interest rate rise better than others. First of all, one thing that's been very helpful almost across the board has been the fact that most countries have switched in the last 20 years from fixed exchange rates to flexible exchange rates. But beyond that, the impact of the Fed's monetary tightening is more acute in countries that have a weak macroeconomic set of fundamentals, that have large current account deficits, limited public finances, and large borrowings in foreign currencies, including US dollars. Examples might be a Brazil or an Indonesia. Moreover, countries such as these, which also depend heavily on commodity exports, have been hurt significantly by lower prices of commodities, especially in crude oil, and that's hurt their economy as well. On the other hand, some of the more reform-minded emerging markets, such as a Korea or Taiwan, where you have larger foreign exchange reserves, low dollar-denominated debt, strong current account balances, and solid public finances, they're better able to deal with the Fed's policy and its tightening. Just a note on India, as most of you know, while India is a debtor country, it has strengthened its macroeconomic framework, and it depends more on domestic consumption than on exports, and so it's been able to fare relatively well in this climate. Moreover, as was mentioned this morning by Minister Jaitley, because crude oil imports constitute a major component of India's import basket, the lower crude oil prices have actually helped narrow India's current account deficit. Now, the one other point I wanted to mention is that this is not just a one-way process where you're looking at the impact of the U.S. economy on emerging markets. There's a feedback loop, and emerging markets have an impact on the U.S. economy. And the softening of growth in emerging markets does affect the growth back in the United States. And the IMF has, I think in a study, shown that a slowdown of about 1% in the emerging market economies reduces growth by about 0.2% in the advanced economies. And that's why a potential slowdown in China and elsewhere does present some risks for the advanced economies, and it's why the Federal Reserve Bank is being very cautious about how it raises interest rates. Let me just conclude with a couple of quick observations about the United States, and as it's been mentioned, and I think will be talked about more by some of the other panelists, the uncertainty that surrounds the outcome of the 2016 presidential election. One key point about the United States is one of the reasons why it remains such a resilient economy is because it is an engine of innovation and of technological advancement, and that can have a real positive impact on emerging markets. For example, technological innovation in the production of and use of clean energy could have a profoundly positive impact on India, on China, and other emerging market countries. And this type of entrepreneurship is really a great part of the U.S. model and its impact generally. On the other hand, the political discourse these days in the United States is full of some strong rhetoric that's against trade, against outsourcing, against immigration. And these could create problems. Part of the reason, in my view, for this type of rhetoric is the philosophical debate that's going on between policies that are aimed to deal with inequality and policies aimed to focus on growth. And indeed, some of the rhetoric you're hearing is a backlash against the pro-growth policies of free trade, which do displace workers and create some job losses. But I think it's a mistake. While the problems of income inequality are real and the loss of jobs are real, you're not going to be able to solve them unless you're also growing the economy. And so we have to be careful that some of the rhetoric that's now on display, if it actually went into effect, would have a negative impact on growth in the United States, which would then have a negative impact in the emerging markets as well. I should add to this, though, that in the past several years we've seen a real gridlock in the United States Congress, which has prevented a lot of major changes in policy. And some of the policies being spoken about in the election would require congressional action. And in this case, gridlock may be a good thing. So let me conclude really by saying again that the interconnected financial markets, along with the U.S. political process, do add a degree of sort of uncertainty and potential volatility in terms of the impact of the United States on growth in emerging markets and elsewhere in the years ahead.
Thank you so much, Ken, and I'm sure we'll return to some of those questions around increased volatility, which I think you've closed your comments with. So, Nicholas, would you like to continue?
Yep. Thank you very much, and thank you to the organizers of GrowthNet and my friend NK, Singh, and all those involved for putting together yet again such an inspirational, thoughtful gathering. I'm not going to do the 15 reasons to be anxious. I think you've probably had more than 15 already at lunchtime. I'm going to try to look at more medium-term questions and ask the Indian question, which is what to do. And I'll be asking what can emerging markets do, countries do, to make them more resilient and less dependent on growth and excitement that goes on in the US and the other rich countries. And I think the answer is that there's a great deal that they can do. So looking to the medium term now, and that's where I'll focus. Let me start with the United States, but then most of what I have to say will be outside the US. There's a lot of talk in now US, our friend Larry Summers and others, about secular stagnation. That somehow we're going into a period in the rich world, and they're writing particularly about the United States, but they could also make it about Europe, where powerful growth should no longer be expected. Should we be expecting 2.5%, 3%? And they're suggesting actually we should be expecting rather less than that. I don't believe that, and I think it's very important to think about the reasons why. And the primary reason why I don't believe that is that we're seeing in many ways the fastest technical progress that the world has ever seen. Who knows how far we're into the digital revolution. Most of us, I think, would suggest we're nowhere near halfway in. Who knows how far it's got to run, but a long way. Enormous change in materials. I mean, graphene is an outstanding example, but right across all sorts of building materials, generating materials, have transformed what we can do. And of course, we've got the whole biotech story, which is moving very fast as well. And there's more. And of course, there are great returns to how those three things interact. And we actually have reason to be confident that this is going to go on, not simply because of the nature of those discoveries, which we know have a long way to run, but because what we've seen now is a change in the technology of the production of ideas. We're seeing ourselves look very hard. Artificial intelligence is just one example. But we're seeing a transformation in the way in which innovations are created and come about. So we've got not only improvement in those technologies, but we've got improvement in the technologies for producing technologies. And I think that gives us reason to be confident that those things will continue. And I also think that what we've seen is leading us to rather bad underestimation of output. 15 years ago, to do the equivalent of Skyping your grandchild would have cost you a very large sum indeed. You probably could have done it with a very heavy investment, but it would have cost you a great deal. Now you get it for nothing. That's not in GDP. It's not there, but it's very real in terms of consumer satisfaction, which is possibly what GDP ought to be trying to capture. Well, that's another story, and I'm not totally convinced that it should be about that. But we're really underestimating our outputs. And because that's changed a great deal in the last dozen or so years, because it's changed the degree to which we're underestimating our outputs, it means we've underestimated our growth rates. My colleague at the London School of Economics, Sir Charles Bean, who was the Deputy Governor of the Bank of England, many of you will know Charlie, has just reported at the request of the UK government on the understanding of our national statistics, which were put together really by the great students of Keynes shortly after the Second World War, James Mead, Richard Stone, both of whom won Nobel Prizes, and it was very much around activities because it was born of the Keynesian story of thinking about what determines employment, what determines activity, rather than necessarily what determines output. We shifted over in that direction later on in the history of national income statistics. But we did shift over to think about the nature of output and consumer satisfaction and so on. And Charlie estimates that currently in the UK, we may be somewhere between 1/3 and 2/3 of a percentage point underestimating the growth rate. That's a lot in underestimating the growth rate. So not only am I optimistic about the prospects for medium-term outputs in the US, which is the great, in many ways, one of, not the only, but probably the main great fountain of these ideas. Not simply because those are going to go on and some of them may accelerate, but also because we've been too pessimistic about growth rates and expressing those growth rates. So I do think that not just looking at looking beyond the short-term stories which are important about employment and so on in the US, which is going along quite well, I think the medium-term story is quite positive also. So having said that about the US, what about the emerging market economies? Well, of course, one thing they can do is think about where those technologies are going and be part of them. And they have already started to do exactly that, be part of those technologies, and we're going to see a lot more of that. But the second topic I wanted to raise was the importance of the emerging market countries seeing themselves as not simply drivers of growth. It's hard not to see themselves as drivers of growth because they obviously are, and they're the most important part of world economic growth, but also as places of resilience. And that's something which is in the future. And Urjit Patel used very interesting language at a small breakfast this morning. He said people spent a while looking at return on capital. That's what Ken argued just now. They were looking at places to get better return on capital. But all of a sudden, they started to be thinking about the return of capital. Would they be able to return their capital? And I thought that was quite interesting language. And it raises the question of how far can emerging market countries be not only the places to go when you want to make a bit of money, but also places to stay in or retreat to when things get rough. And I think that's beginning to happen. And what's involved in doing that is the kind of thing that we've been discussing throughout today. It's the investment climate, how reliable things are, how well they work, how well your financial structure operates, things that give people confidence that their money is reasonably secure. Total security is not on offer. The world's uncertain, but makes that confidence grow. I think in the conduct of monetary policy and the conduct of the RBI over these last years, we've been seeing a great deal to bolster that story. So I think as well as being places where growth rates are high, I think the move, and it's happening, although it's not that, obviously it's got a long way to go, the move to being places where your assets are secure will not only boost the investment rate, but it will also protect against volatility. So I think that should be an explicit part of the story. In terms of where the investment's going to be, that's just overwhelming. I mean, China saves more than the United States and Europe put together. Yeah? If you think about infrastructure investment, it's a bit over $3 trillion a year worldwide. That's going to go to $5, $6, $7 trillion a year in the next 10, 15, 20 years, with nearly all the increase being in emerging markets and developing countries. It's where the savings is, it's where the infrastructure investment is and will be, it's where the growth is going to be. There'll be ups and downs, but that is the reality of the way in which it's changing. So the clout and the power to be not only the place for investment, but also the place where investment and financial assets are reasonably safe is coming. And I think it should be an explicit objective to make it come even quicker than it's coming. And I certainly salute what the RBI has been doing in that connection. The third point I wanted to make is that emerging market countries are changing and can change the international economic architecture. I was personally very closely involved from the inception and setting up the new development bank, the BRICS Bank. I'm closely associated with the Asia Infrastructure Investment Bank. Those two are an example of initiatives where the emerging markets and developing countries have essentially said, well, we've been trying to reform these other institutions for a long time. We haven't been terribly successful. So we are the places that are doing the savings and the investment. Why should we be sending our funds through somewhere else and coming back to us to organize all this? So we'll organize it ourselves. Absolutely sensible. And it's begun. It's happening. And that's a very important part of this story. There used to be a time, many of us will remember it, and okay, you were very much involved in interactions of India and the G7, and then they had these extraordinarily patronizing things where the G7 would meet and then be some important countries outside, and after the G7 had exchanged their words of wisdom, they would invite in enormous countries like China and India, so and say, well, now you can talk to us. We've had our chat. That's gone, really. The G7 is a minor occurrence. The action is in the G20. And essentially, it arose because the rich countries realized that they had to have those round the table to have an intelligent discussion of the world's problems, but also because those countries outside the G7 said, we're not going to be waiting outside the door. And it went, what's the point? We're where the action is, maybe you can come and join us. And so the G20 happened, and that's the place where it happened. So I've given just two examples. The AIIB and the NDB as these new banks challenging, competing with, but I hope also cooperating with the existing institutions and the G20. One final example, though very close to my own heart, was COP21 in Paris. An enormously important agreement, astonishing that 196 countries actually agreed on something important and substantive. But they did. One of the reasons it changed was that the leadership moved, and India became part of that leadership. When India changes from responding and batting back suggestions to actually taking the lead and making the agenda, things move. And there were many reasons for the success of COP21 in Paris, but one of them was the way in which India became a leader in that story, particularly around innovation and Prime Minister Modi's intervention on those fronts. So I've given three examples of the way in which the shaping of the international economic architecture and international system is moving. And I think it's going to move a long way. And that will be part of this story of the emerging market economies becoming a place which is not only a destination for investment, but a destination when times get a bit rough as well. I've probably run out of time. I've just got back from the China Development Forum. If the discussion develops that way, I have a few reasons not to be too pessimistic about China.
Great. So thank you so much, Nicholas, and I'm sure China will come up in the discussions and the Q&A, hopefully. So Rakesh, I'll move on to you.
Let me start by first commenting on what your wife said to you this morning. If Trump becomes US president, maybe the Puerto Ricans would be very happy not to have US passports. And given that they also have a sovereign debt crisis, even though they're not sovereign, that then IMF could rescue them, which they can't now. So it would not be such a bad idea for Puerto Rico to get their own passports. Unfortunately, half of what I'd prepared Ken said, and the other half Nick said. So I will now have to innovate and maybe just embroider around their themes. First, starting with the US Federal Reserve, he described really very succinctly everything the US Fed has done since the North Atlantic financial crisis started. Note I said North Atlantic financial crisis. Everyone in the world, including in India actually, called it the global financial crisis. It was nowhere near a global financial crisis. It's only the Euro and American centrism, in a sense, that called it a global financial crisis. They never called it the Asian financial crisis. They never called global financial crisis when we had the Asian financial crisis. To my knowledge, in 7 years, in 8 years since 2008, not one financial institution in either Latin America or Asia has gone down. So let me just say that since the North Atlantic financial crisis, the US Federal Reserve has really done an absolutely outstanding job. The kind of courage and innovation shown by Ben Bernanke and then Janet Yellen is really truly admirable. However, today, the US Fed policy is probably the main cause of economic uncertainty in the world. And this is despite the fact that I have greatest respect for Janet. I think she's really marvelous and she's doing a tough job. But the problem that is occurring is that given the kind of recovery of the United States that Kenneth described, the US Fed started announcing that they're going to normalize policy. Before the last December's first increase in the policy rate, the expectation was that there would be an increase of something like 175 basis points by the end of 2016. And one of the new fashions, which I'm very critical of in global central banking, of forward guidance, has caused further problems in the sense that both in the UK as well as the United States, forward guidance keeps being revised because you can never tell actually what's going to happen in the future. So the first point really is that given the kind of expectation that was formed by the US Fed of an increase of 175 basis points, that is 7 times of 25 basis point increase between in 2015 and 2016, has clearly been belied. And the also original expectation was that it will increase by about 350 basis points when they reach the steady state. The question really is, in terms of uncertainty, will US Fed policy ever reach the steady state, 350 basis points above where they were last year? They're having to revise what they're going to do almost in every meeting. And again, I'm not saying that's a bad thing because that's what they have to do, but it is causing great uncertainty in global financial markets. That's resulting in a great volatility in capital markets. We saw what happened in global capital markets in December, January, February, and it's now again got somewhat stabilized. And the question is what will happen in the future. The second reason why this uncertainty is prevailing is this divergence, which again Ken described, that whereas given the US economic recovery, the US Fed is trying to normalize monetary policy and essentially raising interest rates, hopefully. But at the same time, of course, the ECB and Bank of Japan are going the opposite direction. So there's a great divergence between the 3 largest advanced economy blocks, monetary blocks. Given that divergence, is partly because of divergence that the US Fed is then stymied, because with the higher accommodation of monetary policy of the ECB and the Bank of Japan, that the impact of that is essentially on the US exchange rate, the dollar appreciating. With the dollar appreciating, there's downward pressure on inflation, so that the general US Fed formula that look, we'll increase rate when we are confident of reaching a 2% inflation rate, keeps getting dampened, because with the other economies doing further monetary accommodation, there's pressure on the US exchange, the dollar to appreciate, lower pressure, downward pressure on inflation, and also downward pressure on the economy. And that's sort of what's causing this uncertainty of policy in the US Fed. So that's the sort of divergence between the US and the other advanced economies. But that's not the whole story. There's even greater divergence going on with the rest of the world. So among the BRICS, which until say a couple of years ago were usually sort of roughly doing similar things, they were growing well and so on. But what has happened now, that with the downturn in oil prices, Russia of course is in great difficulty. Brazil also got affected by the downturn in oil prices plus other commodity prices. And of course they've added to that by their own policy follies. So Brazil is in really very, very deep trouble. South Africa also got affected very significantly by the downturn in other commodity prices. So of the BRICS, it's only India and China which are growing. So as I said, first the divergence in monetary policies in the US, between the US and the other advanced economies on the one hand causing uncertainty, and now now with this greater divergence among the largest emerging markets, there's even greater uncertainty in the world. So in some sense, one key current feature, before in some sense we get to the nice medium-term future that Nick has outlined, a current feature of the global economy is really much greater volatility and uncertainty than we've seen for almost 25 years. In the sense that even in the time of 2008-9, there wasn't as much uncertainty because everyone's going down at the time. So there wasn't this kind of divergence taking place in 2008-9. And the other problem that we've got into with the unconventional monetary policy that Ken described across the advanced economies, US, Europe, and Japan, that with interest rates basically zero or near zero, asset prices have gone up everywhere. And you know, therefore, almost with certainty, that as and when and if interest rates do increase, you are going to have a bond price bath, a bath in the bond market. Who's going to sustain and absorb all those losses? We don't really know because this has never happened before. And of course, there will be great amount of financial volatility. So to summarize this part, that is with the UMP, that is unconventional monetary policy all around, we have uncertainties in exchange rate movements, deflation in Europe, low US inflation and exchange rate appreciation, hence possible continuing delays in US normalization, resulting in volatile global financial markets, and also uncertain trade growth. Let me now come to India. In general, Asian emerging markets, as Nick described, will continue to prosper, even if growth rates are lower than what they were in the first decade of the 2000s. Latin American emerging markets will indeed probably stagnate on the back of lower commodity prices. Africa will also exhibit reasonable heterogeneity, that obviously commodity producers will suffer low growth and the commodity importers will probably be okay. And of course, the oil and other commodity exporters will exhibit slow growth. China is obviously slowing down, but remember, growth of 10% at 100 is the same as growth in 5% of 200. And China is clearly 200 of what it was just six, seven years ago. So even with China slowing down, its impact on global demand is going to be continuing to be positive. Now, one general point that Nick made, I think, is very, very important, which is, I'll put it slightly differently. We are actually going through an epochal change after 200, 250 years, that the fulcrum of global economic activity is in the process of moving from North Atlantic to the Indian Ocean. It's after 200, 250 years. That is, if you take the weight of China plus India plus the rest of Asia, there's going to be much greater than half of the global economy within the next 5 to 10 years. And so this is a huge change taking place, and Nick described its consequences on international economic governance. And I think it's going to be much more than that. And however, that is also causing, that's overall I think a good thing, but it's also causing two kinds of uncertainties. One, that we've got used post-World War II in the Bretton Woods system of having one top dog, that is the United States, who overall I would say has done a reasonably good job of keeping the world global financial and monetary and economic system in order. We're now going to have a mixture of top dogs, and they will have to, that is the US and China in particular, and we're going to have to figure out ways and means of those two top dogs working with each other to keep some stability in the global economic and financial system, and it remains to be seen what kind of cooperation systems will result from this distributed economic power across the world. Just quickly going to specifically to India, the key first point to note is that we've had continuous growth actually since the 1950s. Second, we've had 6 to 6.5% average growth for the last 35 years. So there's no reason why we shouldn't have 7 to 8% growth over the next 20 years. We've always had we've had increasing gross domestic savings and investment. They're around 30% now, a little over 30% now. We need to go up to about 35% plus. Demographics are on our side. We are among the biggest beneficiaries of the oil and commodity price downturns, and we have, as I think the finance minister said this morning, we benefit from all of that. So we can really take advantage of the current situation. One, focus on manufacturing. That given that the capital equipment prices in the world are at historic bottoms, our manufacturing companies should really take advantage of the very low capital equipment prices and, of course, low interest rates. We can do better management of the exchange rate than I believe we've been doing for the last 5-6 years. Obviously, ever since I left the Reserve Bank, it was much better before I left, since I was doing the exchange rate management at the time. Now we seem to like the appreciated exchange rate affecting all our manufacturing and exports. We can have a much greater focus on taking advantage of the labor-using manufacturing moving out of China. It's going today to Vietnam, Philippines, etc. Much more can come here. And we need to build more reserves to protect ourselves from the kind of global financial volatility I described earlier. So to summarize, basically what I'm saying is that overall emerging markets will slow down, but still there will be much higher growth than the advanced economies. We need to focus much more on them as sources of demand in the United States. In general, India needs to look much more towards Asia than North America. The old slogan was, look east. Prime Minister Modi says, act east, and I certainly agree with that. US developments that I describe will certainly affect global financial markets, but we can protect ourselves building greater reserves, and by building greater reserves, we can affect the exchange rate in the right direction. Thank you.
Thank you so much, and I'm sorry for putting a little pressure, didn't finish, but thank you so much. So last but not least, we have Nelson. Nelson, over to you.
Well, thank you very much, Soumitra. I'm going to speak about a different cycle, not the economic cycle, but the political cycle, at least in my country, the United States, and my view of how that will impact and help you understand how that might impact U.S. international economic behavior, both in the rest of this year and in the next administration. I travel broadly, as you might expect, mostly on behalf of our clients, large global companies, Indian companies, helping them do business, deal with governments around the world. When I do travel, I tend to also speak about the U.S. political election. I've been overseas now 4 times since January 1st. This is my 8th country. And in those 4 trips, I've seen the interest in the U.S. political race grow from fascinated to riveted to terrified. On this trip, I've been to Singapore, I've been to Vietnam, now here in India. We reached the terrified point. Let me try to give you a sense of what I think is happening in the U.S., give you a framework for looking at the political process over the next several months in both parties, give you a sense of how that might translate into November. Remember, I'm a Democrat, so there are others in the room. Ken Jester served with distinction in both Bush administrations. Steve Biegun has served with distinction on the Republican side. If they differ, you can ask them afterward how their views differ. But I'll give you a framework for, I think, how this is going to impact in November. And then lastly, how this conversation we're having in the U.S. about politics is going to affect international economic policy in the U.S., particularly with regard to trade toward countries like India, Brazil, and others. First of all, on what's happening in the parties. There's no doubt that there is a conversation going on in both parties about income inequality, about those who feel that they have been left behind, even despite the strong recovery, which Ken noted, from the financial crisis, those who, frankly, over the last 30 or 40 years of deindustrialization in the U.S., not exclusively a U.S. phenomenon, but one that is very strongly felt in parts of the U.S., has left behind certain voters and has created a conversation in both parties about the direction. How can government policy help and benefit those who have been left behind? How can U.S. government policy deal with those who have clearly done very well over the last 30 years? And what's the fair way and the way to promote growth under both? That conversation is expressing itself differently in both parties. In the Democratic Party, the race between Hillary Clinton and Bernie Sanders, it's a conversation. It's a respectful conversation. It's one that has to do, are we going to be in the U.S. a center-left country? Will the Democratic Party be center-left? Are we going to be a left center-left party, which is where Bernie Sanders would like it to be, one or two paces to the left? We haven't had that discussion in the Democratic Party in 30 years since Bill Clinton came in with the New Democrats, pro-free trade, working with business, working to balance the old concerns of the left with the realities of the economic situation. He pinned us just to the left of center. That was 25 years ago. It's time to have a healthy conversation in the Democratic Party about center-left or left-center-left. There's also some personal issues. Hillary Clinton is someone who has been in the public eye for 25 years. I think Frank Wisner today put it very well. She has been subject to continual attacks for most of that 25 years, and that clearly has led to a perception about her and that has stuck in the public mind. But the conversation that's happening in the Republican Party is a different one. And I have this for my Republican colleagues. I served in the Clinton administration. I used to work for Vice President Biden when he was senator in chair of the Senate Judiciary Committee. But I talked to my Republican friends, and the word that they use about what they feel is happening in their party today is a fracturing of the party, or the risk of a fracturing of the party. And this is really being promoted by Donald Trump. It is taking that conversation about who's being left behind, about inequality, about how do those who've been left behind express that grievance and that frustration. And he's putting it in terms that break the mold of where the Republican Party has historically looked at these issues. He's saying, you know what? Maybe taxes are too low on the rich. Maybe they need to pay more. Social Security, you guys need that. I'm not going to touch that. Trade, no, I think it's a bad idea. I think it loses jobs. I'm with the working man. I want to keep the jobs here in America. It's creating a discussion in the Republican Party that really is a fundamental one. What you're seeing now over the next several weeks will be between Ted Cruz, who's as conservative as any member of the U.S. Congress, of the U.S. Senate, and has positioned himself quite carefully there, very orthodox on the views, low taxes, low regulation, low spending, small footprint, with Donald Trump, who has a very heterodox view of how the Republican Party should solve these issues. The concern that my Republican friends have is that this conversation will wind up being an exclusionary conversation, because at the end of the day, some people are going to feel that they lost that conversation, and they're going to step away. They might step away from the candidate. If Donald Trump wins, the conservatives will be deeply concerned that he's going to be taking them in the wrong direction. And they're going to take their personal antipathy toward him, toward his public persona, and toward what they view as his unreliable political views and policy prescriptions. And the conservatives will feel that they've been left behind, and they will at the very least stay home. In some scenarios, perhaps they'll find another candidate to support. On the other hand, if Ted Cruz is the candidate, those who like Donald Trump's, this is the Reagan Democrats, the working class whites who moved from the Democratic Party to the Republican Party, the concern is that they will look at Ted Cruz and say, that man doesn't represent what we think is wrong with America and what's going to fix America. And they will either bolt and follow Donald Trump in a different direction, or they will stay home. So the Republican coalition that will leave the convention will be smaller than the typical Republican coalition, with obvious results in November. So that's my sense of what's happening in the two parties. What I would judge as a fairly respectful conversation in the Democratic Party and a fairly deep and divisive conversation going on in the Republican Party. How will it translate into November? Obviously, from my view as a Democrat, I think this will benefit Hillary Clinton. There is certainly concern in the Democratic Party now in the middle of a primary. There always is, and disagreements between the candidates. But at the end of the day in November, they will look at Hillary Clinton on the one hand, Democrats will, and they'll look at either Ted Cruz or Donald Trump on the other, and their choice will be very clear. They'll come back to Hillary Clinton and they'll support her. On the Republican side, as I indicated, the coalition, in my judgment, is likely to be smaller than what we've seen before, at a time when the Republican constituencies are shrinking anyway. You know, even if Donald Trump or Cruz got the exact same percentage of the white vote, of the male vote, of the middle-aged and senior vote that Mitt Romney got, he'd be defeated even more handily this time around than Mitt Romney was 3 years ago. So the scenario was likely to lead, in my judgment, to a Hillary Clinton victory this fall because of the way that this conversation is playing out. Now, what does that mean in terms of international economic policy? This conversation about inequality has caused those to raise questions about protectionism. Is free trade good? We've seen in both parties, we've seen leading candidates express concerns. Hillary Clinton, who has been on record, someone counted 45 times supporting the TPP and trade agreements, has said she has concerns about this trade agreement, and she would like to take a hard look at it and think about ways that she can come up with better policies to deal with trade. Some have attacked her as being cynical. I think she's listening to the voters. You know, if you're a politician and you're standing for election, if you don't listen to the voters and what they're telling you, you're making a mistake. She is listening to the voters. In the context of a campaign like this, India knows this. I don't have to tell Indians about what political campaigns are like of any country in the world. Rhetoric gets overheated, positions get locked in. She, at the end of the day, however, is someone who is former Secretary of State, as senator of one of the most economically powerful states in the United States. She understands where America's economic interests are. And my judgment is that she will come back to the trade agreements, and she will make changes. I'm not saying that she is going to just simply put a fig leaf on things and dust her hands and walk off. She'll have worker retraining. She's going to want to think about how we can take care of, ensure that companies don't move overseas willy-nilly. She's going to want to ensure that trade agreements take care of labor rights and others. These will be issues of real conversation here in India. But I think she will be responding to what she's hearing from the voters. On the Republican side, I have less of a prism there. Donald Trump has been so vociferous on trade. Ted Cruz has been following his lead on that. But I come back, and this is where I'm going to end. I come back to where Frank Wisner took us today at lunch, which is countries have national interests. And the national interest of the United States has been for decades in global engagement, in a trading system and in a global system that has the United States interacting greatly with countries, building alliances around economic engagement. And the national interest of the United States, in my judgment, whether it's a Hillary Clinton presidency where I have a fair degree of confidence that I know where her policies will be, or a Cruz or a Trump presidency where I have less confidence, but I do know that they will feel the same national interests that have been there for decades. that they too will come eventually to a place that will not feel too differently from where Barack Obama has been, from where George W. Bush, from where Bill Clinton, George H.W. Bush, and so on going back. I think I'm intending to give you a bit of comfort here at the end that despite our loud, fractious political conversation that we're having right now, that at the end of the day, we're going to wind up, our system will ensure that the rest of the world can look at the policies of the United States and feel that the policies that emerge are still bound by those national interests and by the historical practices of the United States. So thank you very much, Soumitra.
Thank you, Nelson. So this has been, I think, probably one of the most clear articulations of the recent political debate in the US that I've heard. So thank you so much. I can take the remainder of the time with my question, but I'll be generous, so I'll let you ask the questions instead. But please keep your questions short and indicate the panel member you want to address it to. And my request, panel members, is keep your responses short. We can get a few more questions in the process. So let's get a few questions. Hands up. Just raise your finger, raise your hands. We'll collect a few questions together, and then we'll answer them together. Please, Claude, why don't you say your question?
Claude Soumitra. I wanted to get back to one thing you said, Mr. Juster. You mentioned that a downturn in the US is not totally out of question. I think I'm quoting your words. Of course, we have spoken about the uncertain global environment. What would be the possible causes for this kind of downturn if you look at domestic US factors?
Okay, I will collect a few questions and then come back to you. So, NK,
Yeah. I think my question is equally to Juster as to Rakesh, since both of you made the point about the divergences and the lack of synchronization in respect to monetary policies. And that while monetary policies in some parts have moved significantly down, the US is in the reverse cycle of the tightening of the monetary policy. Now, considering the cooperation which now exists within the forum of the G20, and considering the fact that governors of central banks, even though they have a domestic charter and a domestic mandate, do also have consultations, isn't it possible to reduce uncertainties if there is greater cooperation and greater understanding in the governors of the central banks in charge of the conduct of monetary policy in respect of their countries?
Thank you. Any other questions? Yes, please.
I have a simple question. The name is Bozkurt. I wish Mr. Jackson could answer the question. It is how this negative interest and the liberal, the capitalist system continue to function? And is it sustainable?
Okay.
If it is not so, what the outcome?
One final question. Yes, please, in the center, and then I'll get the panel members to answer.
Mr. Cunningham, you are comparing for Hillary Clinton. Do you think she will be successful in economic matters because she failed in secrecy of emails? How she is going to handle economic matters?
Okay, so we have 4 questions. Why don't we just see how we respond? Ken, do you want to begin?
Okay, just very quickly on what might potentially cause a downturn in the U.S. My view is that the U.S. economy is growing at a steady pace, but I was indicating 2 possibilities. One, because of the feedback loop from emerging markets, that a significant downturn in emerging markets could have a negative impact on the United States, which is one reason why the Fed has stretched out what its initial plans were to raise interest rates and has slowed that down, which has its own risks associated with it, as Rakesh stated. And then I also indicated that if some of the rhetoric you're hearing from both the left and the right in the election were to actually come into policy with much more protectionist policies, that could also have a negative impact. And I don't want to get into all the points that Nelson was talking about, but I would say that some of what you're hearing from Bernie Sanders is not left of center left, but far left, just like what you might be hearing on some of the Republican side might be far right. You know, it's sort of the objective version of the Civil War from the Southern point of view. Different people will analyze the situation differently. And, you know, I think Donald Trump is more of a personality-driven phenomenon than it may be of a philosophical debate that's going on in the Republican Party. But those, to my point of view, were the two types of risks. But I generally think, as I also indicated at the end, and as Nick talked about, the U.S. economy is very resilient, and in part it's because of the innovation and technological advancement, and that can have a hugely positive effect, both domestically and abroad.
Thank you. Rakesh, on the cooperation between banks?
Yeah, let me just first make one comment.
Yeah, we have very little time, so you've got to be very quick.
You always tell me to.
Because you're closest to him.
I'm happy not to talk, actually.
No, please, but we have time.
Dick, why don't you go?
No, it wasn't anything for me.
You don't want to speak?
No, I mean, if I get interrupted, I can't, as soon as I start speaking.
Please give a short response, yeah.
I hadn't even started when you said give a short response. No, I was going to say that on this issue of a possible downturn in the US, what some people are saying is that because it's been a slow recovery, it's already been recovering for 6 years. And if you look at previous business cycles, it's very seldom that you go on growing without a downturn for as long a period of time. And therefore, you're sort of due for a downturn. That's one of the arguments that people make. On the cooperation, very clearly there's much greater discussion among central bank governors, both in the BIS, in the G20 and other fora. But the objective problem of the US hopefully continuing its recovery and Europe and Japan not recovering and still being somewhat stagnant, that even with cooperation, there is not much choice but to have that divergence. Now, what the cooperation can do is perhaps better communication of what they're doing, but that still doesn't solve the issue of there being a divergence. That still doesn't solve the problem or the issue of there being a continuing divergence. But even if they talk to them, what do they do? As long as the Japanese and US and European recoveries are very shallow or not recovering at all, then you have no choice. And a footnote to that is a question from there, that this negative interest rates and continuing unconventional monetary policy is totally uncharted waters. So you don't know what's going to happen at all. And I would share your apprehension on how we're going to get out of this. So I think that remains a problem.
Well, I've been just given a small note that we can take a few additional minutes and go a little over time, so we have a little bit more time for more questions. So Nelson, your
well, the question, I believe, was about the email controversy in the U.S. and about the investigation that's been going on about Hillary Clinton's emails while she was Secretary of State. This is actually a subject on which I know more than the average person, because I spent 2 years in the Clinton White House as the chief lawyer in charge of email policy. And before that, I was a federal prosecutor in New York, working first for Rudy Giuliani and then for his successors, doing white-collar investigations and understanding how it is that you put together criminal cases and criminal indictments. And I don't want to go into too much detail because it's too mind-numbing for you all, but I can tell you what Hillary Clinton did, in my judgment, was not illegal. It was, in fact, permitted under law. You can question whether or not it was the safest way to safeguard her emails, but I'll also point out that it's been well documented that the State Department's own email systems have been penetrated by the Chinese and by the Russians, leading to certain questions about insecurity there. I can also tell you that as a former federal prosecutor in the middle of an election year, where no grand jury has been impaneled. To my knowledge, there's no U.S. attorney that's been brought in to actually investigate this. The chances that there will be a criminal charges this year are next to nil.
Okay, Nicholas, do you want to comment on any of the questions?
No.
Yeah, but the email controversy.
I find it so easy to send emails to people at very senior levels in the State Department from my LSE email. And since I guess that my LSE email is monitored by the GCHQ in the UK, CIA in the United States, and probably if they really want to, China, I would guess, Nelson, I agree with you, it's probably quite easy to get into the State Department email system.
Yeah, Nelson, I think the question sort of implied also is that did she make the right decision by choosing to do the emails in a particular manner? So I think your response indicates that the question indicated whether she made the right decision by choosing to do the emails in the private server. The question was, if I don't understand correctly, is that,
Well,
if she did that, can she actually manage other things in the economy?
Her two
How will she manage actual economics if she did that? But your response was, maybe it wasn't that bad a choice, actually.
I don't think it was nearly as bad a choice as it was. Her two predecessors as Secretary of State both had private, Colin Powell had a private email account. Condoleezza Rice's top aides also had private email accounts. And it's been found that there was information that was exchanged on those that you could go back and look at in retrospect was information that should not have been used on private email accounts. I don't think anybody wants to throw Colin Powell in jail, at least I don't.
Okay, we have some more time for, how much more time would we have?
The next 10 minutes?
Okay, we have 10 more minutes for questions. So Claudia, yeah, please.
Can I do a follow-up? I am a little bit perplexed because you mentioned risk of external shock coming from emerging market. You mentioned China. I would suggest that maybe the risk of external shock, the most possible risk of external shock would not be China, would be Europe.
Yeah.
Because I think we are heading with a moment of truth this summer about what happened with Greece. I think the dysfunctionality of the European Union is increasing by the day. And so I am a little bit perplexed because, to my view, the number one macroeconomic geopolitical risk today is Europe. And I'm a little bit, I would like to hear your views about that, because in fact, when you look at the interaction and the linkages between Europe and the United States, I think in case something happened in Europe, looking also at the banking system in Europe, the risks are much greater than something which I don't consider really a big possibility, say in China.
Some more questions. We'll pick this question up.
I have a question for Nick, actually. A brief question for Nick.
Please.
Just Nick, two questions, and on the demand generation from the United States because of its robust recovery. That some people's view is that because of the income distribution issues, that because a lot of the growth is ending up in the highest income ranges, so you don't generate much demand for goods. One question. Second is, you talked about the great technical change taking place. But as you know, there are many economists who are saying actually productivity change in the last 10 years has been the lowest for 30 years or something. So I just wanted to, if you could clarify those 2 points. Actually.
So we'll collect 1 or 2 questions and come back to it. Yes, please. So can we have the microphone? Who has the microphone?
Indo-US trade has crossed the $100 billion mark. I believe when President Obama met Prime Minister Modi, they set a 500 billion mark target without defining a timeline. Would you like to comment on that? Are we on course on that, or you expect some changes there?
Okay. 1 more question, if you have some. There, yeah, behind. Yes, please.
Hi, thank you. It was a lovely discussion. My name is Pranav Gupta. I'm a 4th-year law student. So my question is that when we speak a lot about the changing global financial architecture, is anything really changing? Because I mean, the IMF and the World Bank is still dominated by the Western countries, and the AIIB and the BRICS Bank are not considered to be institutions that are supposed to act as alternatives to either the IMF or the World Bank. So when India's voting rights changes from 2.2% to 2.6%, is that really a substantive change? My question is directed to Mr. Rakesh Mohan.
Great.
Thank you.
So we begin. So we have, I think, 4 or 5 questions out here. Rakesh, you want to begin?
Yeah, just a quick answer to the last question. I half agree with you, which is that the immediate change that has taken place in the IMF voting, and quotas, is actually not very substantive, right? And it really won't make much difference in the governance of the IMF. However, assuming that that the IMF is supposed to do a review every 5 years, assuming that the same review is done next year, because we're already late for the next review, and again in another 5 years' time, then you would see a significant change taking place, particularly with Chinese quotas actually going up very significantly. And that's what I was alluding to in general, in terms of the sharing of economic power between China and the United States. Second, on the same issue, that what has happened in the world is that between the European Stability Mechanism, which has a authorized capital, if I remember correctly, of 800 billion euros, is actually larger than the IMF. Chiang Mai, which is the arrangement between Asian countries, which of course has not been used, is, if I remember correctly, is 400 billion or something like that dollars. So what you're also seeing is a change, that there's a greater variety of institutions emerging, which would then have a say if there was a crisis somewhere. So ESM is already in action. I mean, the Europeans are already in action in terms of Greece and other European countries. So in that sense, there's this change going on. How it will come out, we don't know.
I would just make the quick clarification that I don't disagree with the point you've made about the importance and impact of Europe. I was perhaps artificially restricting myself to the emerging markets in the United States because that was the topic of our panel discussion, but I take your point and agree on the importance of Europe and the European economy.
And actually, just the Brexit, you mentioned Greece, also Brexit possibility,
Brexit, yes,
which Nick could perhaps comment on.
Impact.
Nicholas, there are 2 questions addressed to you by Rakesh.
Yeah, I am a European, so I probably should comment, and I'm certainly a Brit, so I should comment on Brexit and Europe and instability. I think productivity has been undermeasured for the reasons I described. I also think that in a number of countries, certainly my own, people who've been thrown out of work from regular jobs as a result of all the turmoil of the last 7 or 8 years have actually come back into work, so they appear in the employment, but they have been doing jobs which are much more sort of fragmented, scratching around, if you like, driving a taxi, where previously they were doing something different. So I think whilst employment's gone up, or recovered, some people have shifted down the employment scale. So I think both those effects, the second, of course, is a real effect on productivity, but the first one, I think, is that productivity is actually undermeasured for the reasons that I described. Will demand be severely deficient because so much of the so much of the growth has gone to the very rich? I mean, a bit, but will it be big enough to make a very big difference? My guess is probably not, because if the Fed and others succeed in expanding demand, they'll expand demand relative to that income distribution. And also, some of them have started to give it away, and the more they give away, the better. So some effect there. I'm not sure how big it is, and it maybe could be offset by these things I described. Europe worries me. I think we should never have had a referendum in the UK. It's a thoroughly bad idea. It was a tactical move where you put an existential strategy on the table, and I don't think that's a very good way to deal with tactical problems with the UK Independence Party, which actually has only one MP I think its influence and its danger was exaggerated, and there wasn't any necessity to go there. But my guess is that it's roughly a 60-40 probability that we will vote to remain in, and the majority will be very small. So there's enough there to make me seriously worried, and I'm not the only one. I think it would be very bad for the UK, but it would be very relevant to the question you just asked, because it would be very destabilizing for Europe. It could well start a snowball where other countries decided to leave, where the commitment to the Eurozone started to unravel. And you may think that's a good thing, and I can see the arguments, but nevertheless it would be a very unstable process. There are serious worries about some of the banks in southern Europe in particular. So I find stability in Europe to be seriously worrying, and I'm embarrassed as a Brit that Brexit is part of that. That will be over by June the 23rd. We'll know one way or the other. But the other worries about the pressures on Greece, for example, which are deep and being made deeper by the refugee crisis, I really do think that those are seriously worrying. And what we need is the Deutschmark to be devalued against the euro, but revalued, I should have said. The Deutschmark should be revalued against the euro, but we don't have the Deutschmark, we have the euro in Germany. So that would have to come about through changes in relative prices. You've seen some of that with wages and prices, under pressure in southern Europe. But if we can't have that revaluation, it would be very nice to have an expansion of German demand. That would be a very good thing.
We have one question which has not been answered in Indo-US trade, the direction and the targets. Anyone wants to?
I think Frank should answer that.
I'll say this as somebody who does follow U.S.-India policy quite closely. $500 billion, it's a wonderful aspirational goal. I think both sides would love to see it get there. We're not seeing ourselves moving there extraordinarily quickly. I would say that I think that one of the reasons we're here in India right now, our delegation from the U.S.-India Business Council, is to talk about the benefits to India of a trade-led growth strategy in which India would engage more with the world, perhaps go as far as joining the TPP, and we believe that would seriously and clearly increase trade between the U.S. and India. That would do it.
Great. So I think
we just do a footnote to that.
Please.
That back at around 2003 to 5, I had participated in the framework agreement with Singapore on the Comprehensive Economic Partnership Agreement, and there was another framework group with China. And the kind of aspirational volumes of trade that we talked about in 2003-4 for 2010 were greatly surpassed, actually. So the point is that if two countries actually start talking to each other and think of things, it often happens that you, in fact, do it. So it's not completely out of question.
Great. So I think we've had a very engaging discussion with a variety of different perspectives. And I'd like to maybe conclude by requesting each of the panel sort of members to just give one brief concluding thought, like what would be a takeaway point that you'd like to convey to the group based on the discussion. So anyone wants to begin? Nelson, you want to begin?
Yes, I don't think people are wrong to be watching the U.S. elections very closely, but I hope that you can leave today with some things to say to your friends and neighbors to suggest that at the end of the day, it's still going to be the good old USA.
Great. Nicholas?
I would say that as a major strategic objective of the emerging market countries should be to get into a position where they are a place to go when things get rough in the world, and they're on the way, but that should be something which should be very high on the list of objectives.
Okay.
I would just reinforce what Nelson said about we may come at issues from a different political perspective, I think the U.S. Political system, as well as its economic engine, is resilient, and things will not change as quickly or precipitously as one might think, and I think you should be comforted by that, hopefully.
Rakesh?
I would just say that for India, we need to be very aware that the global economy is going to be a volatile place in the next couple of years. But we can protect ourselves from that to a great extent. And we really need to concentrate on keeping our own house in order and concentrate on public investment in infrastructure and doing much more on the Make in India campaign to encourage Indian manufacturing to take advantage of low commodity prices and low equipment prices.
Great. So I think you will certainly agree with me that we've had a fantastic set of perspectives on a number of different elements of the US economy and emerging markets. I think we can take a lot of hope in the conclusion which you see emerging, that the future looks bright. And despite short-term volatility which might happen from some situation in the US and some perhaps in Europe and elsewhere, I think we all need to continue to focus on development, on investing in technology and innovation. And I think this is something which will help both the US and also emerging markets. So please join me in thanking our wonderful panel. And thanks to the organizers for giving us an additional 15 minutes. Thank you.
Ladies and gentlemen, we're actually going to roll directly into the next session, so we ask you to kindly keep your seats, and our panelists are going to join the panel right away. Thank you.